Hello, investors and traders, and welcome to this week's market report. I'm AJ Monty, and this is a one-year daily candle chart of the diamonds. That's the Dow Jones Industrial Average ETF, ticker symbol DIA. And if you're new to the weekly market report, understand that I leave my charts with the lines intact from last week's report so you can see how well the forecast worked out. And right here was last Friday, and I said the markets would most likely drop, which they did. The end of the line being my target, as I thought that would be the place the gap would fill, and then we would see a bounce, because 80% of the time gaps do fill, and then after they fill, there's an 80% chance prices will reverse. So we might see a little bit of a bounce here next week, a little bit early, but as we move down to the bottom here, the CCI, I also talked about the acceleration of the CCI to the lower levels and forecasted that we would most likely see a sell signal, which we did. The CCI crossed below that red line, which is the plus 100 mark, and when the CCI drops below that, a sell signal is generated. So what does that mean for next week? Well, notice this candle right here. We have a nice green candle on higher volume. Now, what does that mean? It means that there's a pivot point forming here, and the volume increase is telling us that the buyers are becoming more motivated. So I think next week we could actually go up to test this high, which I'll mark as a resistance line, and I'm going to draw that out just like that, with the end of the line being my target. If you need a number for that, it's 281.65. That would be my target for the diamonds. I'm going to leave this in place just so you can see what happened the week before. And remember, when I leave this intact like that, it'll be there next Friday. Now let's take a look at the Russell 2000, ticker symbol RUT. And I got an interesting question come into our mailbox from Efron Rosario, and it was a good question. He said, why do you use RUT and not IWM? My answer was pretty simple. I'm a creature of habit, and I've been tracking the Russell 2000 with ticker symbol RUT for decades now, and I just never changed. So I asked if it would be okay if I go and analyze IWM. He agreed, so that's what I'm going to do. As of today, I'm going to shift to the IWM, which is the ETF for the Russell 2000. But before I do that, I'm going to analyze what we said last week. I said the Russell 2000 would most likely drop. It did that. Now remember, this was Friday, and the oscillators were starting to roll over with sell signals. All right, so Monday was here. Tuesday, we had a bearish engulfing pattern. Wednesday, we had a long shadow above that candle, which again is bearish, and we proceeded to go and push towards the 20-period moving average. Here's what I think is going to happen for the Russell. Now, to draw that out, I'm going to switch to IWM. Okay, Efron, this is for you. All right, now, you can see now that this ETF, which tracks the Russell 2000, is right at that 20-period moving average. See that? Now, notice the volume. As the price is dropping, the volume is increasing. So unlike the Dow, where we have a green candle, we have a down market in the Russell with a gap below the market. See that? So I think next week the Russell 2000 could drop a little bit before moving up. Just like that. So I'll leave that in place with a pullback to this gap area right here, with an end target by the end of next week for IWM to be 156.65. So that's for those of you that are using that as a target price to manage risk or set your own price targets. There you go. Now let's take a look at the VIX, ticker symbol VIX. Interestingly enough, the VIX came within pennies of hitting my target right there. See, at the end of the line is 25.01. The high on Thursday right there was 24.60 and change right there. And the volatility index closed today with this long shadow above. Now, generally when you see long shadows above the candle like we see back here, that's generally bearish. But because the VIX is already at a key support level down here, I'm going to say that the VIX is most likely going to drop a bit and then start to climb back up in a similar angle to what we saw happen this week. So I'm going to leave this in place, and I'm going to leave this in place as my forecast, with the end of this line right here for the VIX being 23.93. And again, for those of you that are using it as a target, maybe trading options, that's your number. Now, inversely related to the VIX is the SPY. Notice what happened here. We did not go down as far on my forecast line as we did go up on the VIX. So we more or less have the VIX conflicting with what we're seeing here in the S&P. And if we believe that the VIX is going to move down before it goes up, then that means we're expecting the SPY to go up before it goes down. Hope that makes sense for you. Again, they're inversely related. I'm going to shift this over like this. Watch this. I'm going to remove this line. I'm going to move it over like that in a similar angle, but I'm going to do this. I think the S&P could actually go up and break out into a new high here before pulling back, just like that. So this is going to be an interesting week next week. And from what I've seen over the years, the week that follows the monthly expiration Friday, which is today, that generally turns out to be a pretty volatile week. So we're going to see how this all pans out next week. Remember, we have gaps below the market here, which would act as a support level. We have another gap down here, which I'll erase because the upper gap right here would act more as a support, and we'll hit that first before hitting down here. But again, notice what we have. And even though, and this is what we have to watch out for, I'm going to talk more about this. Even though we have a new high today, we do not have a higher high on the CCI. So we are still showing a negative divergence from price compared to the CCI. When Don Lambert created the CCI in the 1980s, early 1980, this was what he pointed out as being the most significant signal, is when you see divergences in the CCI from the price. So in other words, and I talked about this last week, when we have higher highs showing up here like we did this week, but we have lower highs showing up on the CCI compared to these highs even back here, then that is taken as a negative divergence. It's a negative sign that we all have to watch out for. It's a caution flag that if you have any long positions, you really should manage that and keep your risk to a minimum and protect all profits as you move up to the higher levels. Which brings us now to the Qs. The tech sector did not go anywhere near what we forecasted last week, and it kept moving higher. Now, I'm going to erase these lines, but keep this low point in mind, that support level down there. I'm going to redraw that. This support level down here is still very much a viable support level. In addition to this being a support level, the 20-period moving average will also act as a support level. Now, I'm going to do something here that I hardly ever do, and that's I'm going to use the Fibonacci retracement calculator. Keep this support level in mind when I bring this out and use it. I'm going to go to drawings. I'm going to my drawing tools. I'm going to pull up the Fibonacci calculator. It is right here. And I'm going to start that at this low right here, and I'm going to drag it up to the high right here. See this? Now, generally, not all the time, but generally, when you have a nice upward leg like this at a fairly steep angle, you will get a 50% pullback on the Fibonacci retracements, which leaves us at a support level right around 266. Notice where my support level is here, right there, right around 264.5. And notice where the moving average is at 269.97. So this area right in here between the support level, the Fibonacci retracement, 50% pullback, and the moving average brings us right into this area right here. So now that you know where that is, I'm going to erase the Fibonacci's, okay, and then I'm going to draw my forecast line, keeping the Fibonacci retracement level of 266 in mind. So here we go. Here's Friday. What's my prediction for next week? I think we're going to start to see this pullback right around to the 266 level. Now look, I'm going to extend this out at an angle that more or less mimics what we see back here in speed lines. You see this? See this? This is a speed line, basically tracking the mean of this range, high and low, in this downward leg, and I'm duplicating that out. Now, that is not a 1 week forecast. That is a 2 week forecast, right? So for those of you who are trading options, we might even go a little bit higher, but I'm saying that by the end of this period, we'll probably start pulling back to that Fibonacci retracement and to this moving average in this general area. All right, so that's my forecast for the Qs. I hope you're enjoying these reports each and every week. Please do me and everyone else a favor. If you're watching this on YouTube, click on that little alert bell. All right, there's a little alert bell under the video in the frame of this. And once you click on that and you subscribe, it'll notify you when the next report comes out. Again, this comes out weekly. I usually post it either Saturday morning at 6 a.m. or right after the close on Friday, but you won't miss a beat if you click on that subscribe button and click on the alert. And by all means, please share this, like it, and do all that other good stuff that you do on YouTube, because the more people who watch this and follow the signals, the more accurate the signals become. Believe it or not, the more people who follow a buy signal, the more chances people will react on that buy signal, and vice versa for sell signals. It isn't any different than a market analyst raising a price target or putting a buy recommendation out. The only difference is the chart is not a person. It's giving us an actual picture of the supply and demand for each individual stock and each market that we trade. So that's it for now. Have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.